Hello Luxers, and welcome to today's video where we're going to unveil the 10 golden rules of the millionaire stock investor. If you're one of those who want to break free from the 9-to-5 grind and build your wealth through the stock market, then you're in the right place. These 10 golden rules are the success mantras that millionaire investors have used to get rich in the stock market. From investing in what you know to staying patient and avoiding market timing, these rules will help you stay focused and make informed decisions. If you're a greenhorn or an experienced investor, stick with us as we unpack the 10 golden rules of the millionaire stock investor and learn how you can grow your wealth through the stock market. If you're not a subscriber yet, then you're missing out on some top-notch investment tips that could potentially help you achieve your financial goals faster. Now let's get started. Golden rule number 1: invest in what you know. Investing in what you know is one of the most crucial rules of stock investing. When you invest in a company or industry that you are familiar with, you'll have a better understanding of how the company operates and how it generates its revenue. This knowledge can help you make well-informed investment decisions that have a higher likelihood of success. Let's say you work in the tech industry and you understand the technology sector inside out. In that case, you'll be better equipped to evaluate tech companies and identify the ones with the most promising growth prospects. Similarly, if you work in healthcare and know the ins and outs of the industry, you'll have a better understanding of the regulatory environment, and you'll be able to evaluate the risks and opportunities for healthcare companies more accurately. On the flip side, if you invest in companies or industries that you don't understand, you may not be able to evaluate their growth potential, competitive advantages, or risks properly. This could lead to poor investment decisions and lower returns. Investing in what you know doesn't mean you can blindly invest in any company in the industry. It's essential to conduct thorough research and analysis to ensure that the company's fundamentals are strong and that the investment aligns with your investment goals and risk tolerance. Remember, even if you're familiar with a specific industry or company, it's still important to diversify your portfolio to reduce risk. Investing in what you know can help you make informed investment decisions and increase your chances of long-term investment success. So, take your time, do your homework, and invest in what you know to pave your path towards financial freedom. Golden rule number 2: diversify your portfolio. Diversification is a crucial element of any well-rounded investment strategy, and it means not putting all your eggs in one basket. By diversifying your portfolio, you can spread your risk across a range of different investments, which can help minimize the impact of any one investment or sector on your overall portfolio. Investing in a mix of different industries and companies is an effective way to diversify your portfolio. The idea behind this is that different industries and companies are impacted by different market conditions and macroeconomic factors. For example, the performance of tech companies may depend a lot on how well they come up with new ideas and develop new products, while the performance of utility companies may depend more on how the government regulates them and how much commodities cost. Diversification can be achieved in several ways, including investing in different asset classes such as stocks, bonds, and real estate. Investing in different places, regions, and countries can help you diversify your and lessen your exposure to risks that are unique to each country. Investing in companies of different sizes, such as large cap, mid cap, and small cap, can help diversify and reduce exposure to size-specific risks. Investing in different sectors can also help reduce the impact of any one sector on your pool of stocks. While diversification can help reduce the overall risk, it's important to keep in mind that it does not eliminate it entirely. Even a well-diversified portfolio can experience losses, especially during periods of market volatility. However, diversification can help to reduce the impact of these losses and minimize the risk of significant losses. Golden rule number 3: have a long-term perspective. Having a long-term perspective is a key rule of stock investing, as it can help investors avoid the pitfalls of short-term market volatility and capitalize on the long-term growth potential of their investments. Investing with a long-term perspective means taking a patient approach to investing and avoiding the temptation to make short-term trades or react to market fluctuations. Short-term market movements are often hard to predict and can be affected by many things, such as investor sentiment, geopolitical events, and changes in interest rates or other economic indicators. By contrast, investing for the long term involves a focus on the fundamental strengths and growth prospects of a company or industry rather than short-term market movements. This requires a thorough understanding of the company's or industry's financials, competitive landscape, and growth potential. One of the key benefits of having a long-term perspective is the ability to harness the power of compounding. Compounding is the process by which the returns earned on an investment are reinvested back into the investment, leading to exponential growth over time. The more time you have to invest, the more likely it is that compounding will help you make a lot of money. Additionally, investing with a long-term perspective can help reduce the impact of short-term market fluctuations on the overall performance of a portfolio. By avoiding the temptation to react to short-term market movements, investors can stay focused on their long-term investment goals and avoid making hasty or ill-informed decisions. Keep in mind that investing with a long-term perspective does not mean ignoring market conditions or failing to monitor your investments. Regular monitoring of your portfolio and keeping up to date with the latest developments in your investments are important to ensure that your portfolio remains aligned with your investment goals and risk tolerance. Having a long-term perspective is a key rule of stock investing that can help investors avoid short-term market fluctuations and capitalize on the long-term growth potential of their investments. You can use the power of compounding to build a strong, diversified portfolio over time if you are patient and pay attention to the basics of the companies or industries in which you invest. Golden rule number 4. Keep emotions in check. Don't let fear, greed, or other emotions influence your investment decisions. Stay rational and disciplined in your approach. Keeping emotions in check is an important rule of stock investing, as emotions like fear, greed, and panic can lead investors to make irrational and impulsive decisions that can harm their portfolio's performance. When investing in the stock market, it's important to remember that prices can be volatile and unpredictable, and short-term losses are a normal part of the investing process. However, emotions like fear and panic can cause investors to sell their investments during market downturns, often at a loss, in an attempt to mitigate their losses. Conversely, emotions like greed and overconfidence can cause investors to chase high-flying stocks or invest in risky ventures without thoroughly researching the underlying companies or industries. To keep emotions in check, investors should develop a rational and disciplined approach to investing. This includes establishing clear investment goals and risk tolerance, creating a diversified portfolio, and following a consistent investment strategy. It's also important to stay up to date with market trends and economic indicators, but not to let short-term market movements dictate investment decisions. Investors should use some of the following strategies to avoid making investment decisions based on their feelings. Set clear investment goals and decide how much risk you are willing to take. If you know what your investment goals are and how much risk you are willing to take, you can make smart investment decisions that are in line with your personal financial goals. Create a diversified portfolio. Diversification can help lower the risk of your portfolio as a whole and lessen the effect of any one investment on the performance of your portfolio. Develop a consistent investment strategy. If you have a consistent investment strategy, you won't be tempted to make investment decisions based on short-term market movements. Stay rational and disciplined. When making investment decisions, it's important to stay rational and disciplined and to avoid making decisions based on emotions like fear or greed. Know the fundamentals. When researching companies or industries, focus on the fundamental financial and competitive factors that are driving long-term growth and profitability, rather than short-term market movements. We can definitely say that one of the most important rules of stock investing is to keep emotions in check. By setting clear investment goals, making a diversified portfolio, sticking to a consistent investment strategy, and staying rational and disciplined, investors can avoid making impulsive investment decisions based on emotions like fear, greed, or panic to build a strong, profitable portfolio over time. Golden rule number 5. Invest regularly. Investing regularly, like once a month or once every 3 months, is a key rule of stock investing that can help investors benefit from dollar-cost averaging and lessen the effect of market volatility on the performance of their portfolios. Dollar-cost averaging is a strategy in which an investor invests a fixed amount of money at regular intervals over a period of time. By investing a fixed amount regularly, the investor is able to buy more shares when prices are low and fewer shares when prices are high. This helps to smooth out the impact of market volatility and reduce the overall cost of the investment. For example, let's say an investor decides to invest $1,000 in a particular stock. If they invest the full $1,000 at once, they may end up buying a certain number of shares at a high price. However, if they invest $100 each month for 10 months, they will end up buying more shares when the price is low and fewer shares when the price is high, resulting in a lower overall cost per share. Investing regularly can also help investors avoid the temptation to time the market, which is often a difficult and unpredictable task. Instead of trying to guess the best time to invest, people who invest regularly can take advantage of their investment's long-term growth potential, regardless of short-term market changes. Additionally, investing regularly can help to develop a disciplined approach to investing and encourage consistent savings habits. By adding to their investment portfolios on a regular basis, investors can build a strong, diverse portfolio over time and reach their long-term investment goals. Golden rule number 6: don't try to time the market. Don't try to time the market is a key rule of stock investing, and it means that investors should avoid the temptation to buy and sell stocks based on short-term market movements, as this is a difficult and often unreliable strategy for generating long-term investment returns. Market timing involves trying to predict when to buy and sell stocks based on short-term market fluctuations, with the goal of buying stocks when prices are low and selling them when prices are high. But this strategy is hard to use well because market movements are often unpredictable and can be affected by a wide range of things, such as the economy, geopolitical events, and news about a company. Trying to time the market can lead to suboptimal investment outcomes, as investors may end up buying or selling stocks at the wrong time, missing out on potential gains or incurring losses. In addition, market timing can result in excessive trading fees, taxes, and other costs, which can erode investment returns over time. Instead of trying to time the market, investors should focus on buying quality companies at reasonable prices. This means investing in companies with strong fundamentals, such as a solid financial position, a competitive advantage, and a proven track record of long-term growth and profitability. By investing in quality companies, investors can benefit from the potential for long-term growth and value creation, regardless of short-term market movements. To identify quality companies at reasonable prices, investors should conduct thorough research on the underlying companies and industries, analyze financial statements and other key metrics, and compare them to industry benchmarks and competitors. Additionally, investors should establish clear investment goals and risk tolerance, create a diversified portfolio, and follow a consistent investment strategy. In summary, don't try to time the market is an important rule of stock investing that encourages investors to focus on buying quality companies at reasonable prices rather than trying to predict short-term market movements. Investors can build a strong, profitable portfolio over time by putting their money into good companies, doing thorough research, and sticking to a disciplined investment plan. Golden rules number 7. Avoid high fees. This rule underscores the significant impact that fees can have on investment returns over time. High fees can eat away at your returns, thereby reducing the potential for long-term wealth creation. To get the most out of your money, it's essential to look for low-cost investment options, such as index funds or ETFs. Fees can be charged in several ways, including management fees, expense ratios, transaction fees, and other costs. These fees can vary widely depending on the investment vehicle, asset class, and investment strategy. For example, actively managed mutual funds typically have higher fees than passively managed index funds or ETFs since active managers try to beat the market and require more research and analysis. To avoid high fees, investors should opt for low-cost investment options such as index funds or ETFs. These investment vehicles are passively managed and track a particular market index, such as the S&P 500 or Nasdaq Composite, and typically have lower fees than actively managed mutual funds. Moreover, they offer a wide range of companies and industries to choose from, thereby reducing risk and increasing the potential for long-term growth. Now that we are approaching the last 2 golden rules of the millionaire stock investor, don't forget to subscribe to our channel to not miss some top-notch investment tips that could potentially help you achieve your financial goals faster. Now let's continue. Golden rule number 8, do your research. Do your research is a critical rule of stock investing that emphasizes the importance of conducting thorough research before investing in a particular company's stock. Investors can learn more about a company's financial performance, its competitors, its growth prospects, and other factors that may affect the stock's performance by doing research. Before investing in a particular stock, investors should review the company's financial statements, such as its income statement, balance sheet, and cash flow statement. These statements provide a snapshot of the company's financial performance and can help investors assess the company's profitability, debt levels, and cash flow generation. Investors may also look at financial ratios like the price-to-earnings and the price-to-book ratio to compare the company's value to that of its peers and the market as a whole. Investors should also analyze the company's competitive landscape and industry trends. Understanding the company's competitors, market share, and market dynamics can provide insights into the company's growth prospects and potential risks. Investors may review industry reports, news articles, and analyst reports to gain a better understanding of the company's competitive position and future prospects. This information can help investors make more informed investment decisions that are aligned with their investment goals and risk tolerance. Golden rule number 9. Stay informed. Stay informed is a rule of stock investing that emphasizes the importance of staying up to date on the latest news and trends in the companies and industries you invest in. Staying informed can help you make better decisions about your investments and better understand the risks and opportunities they may bring. To stay informed, you may consider subscribing to financial news publications such as the Wall Street Journal, Barron's, or Forbes. These publications provide daily news and analysis on the stock market, companies, and industries. Additionally, you may follow relevant blogs or social media accounts to stay informed about the latest trends and insights in the areas you invest in. Attending industry conferences and earnings calls can also provide valuable insights into the companies you invest in. These events give people a chance to talk to company executives and analysts in person, which can help them learn more about the company's growth prospects and possible risks. Investors may also consider joining investment communities or discussion forums to stay informed and share insights with other investors. These communities can provide valuable perspectives and insights and can help investors stay up to date on the latest news and trends in their investments. Staying informed is essential for making informed investment decisions. By the latest news and trends in the companies and industries you invest in, you can better understand the potential risks and opportunities associated with your investments and make more informed investment decisions. Golden rule number 10, stay patient. Stay patient is a rule of stock investing that emphasizes the importance of having a long-term perspective and not expecting immediate results. Investing is a long-term game, and it takes time for your investments to grow and mature. Therefore, staying patient is the key to successful investing. It's important to remember that the stock market is volatile, and short-term fluctuations are common. But the long-term trend of the stock market has always been up. This means that staying invested over the long term has usually been a good way for investors to make money. When you invest in the stock market, it's important to have a long-term investment horizon in mind. This means investing in quality companies that have long-term growth potential and holding on to those investments for years or even decades. It's important to resist the temptation to sell your investments when the market experiences short-term fluctuations, as this can lead to missed opportunities for growth. Additionally, investors should avoid trying to time the market or make quick trades in an attempt to make a quick profit. These strategies are often unsuccessful, and they can lead to missed opportunities for long-term growth. Investors should focus on a disciplined, long-term investment strategy and be patient as their investments grow over time. This means regularly investing in a diversified portfolio of quality companies, holding on to those investments for the long term, and being patient as the market experiences short-term fluctuations. In summary, staying patient is a critical rule of stock investing. By having a long-term perspective, investing in quality companies, and resisting the urge to make quick trades, investors can successfully grow their investments over time and achieve their long-term investment goals. Thank you for joining us as we explored the 10 golden rules of the millionaire stock investor. By following these principles, you can approach the stock market with confidence, discipline, and a long-term perspective. Remember to invest in what you know, diversify your portfolio, and stay patient in order to achieve your investment goals. If you have any questions or comments about the 10 golden rules of the millionaire stock investor, please leave them in the comments section below. Don't forget to like and subscribe for more investment advice and insights, and see you in the next video.